I was staring at the terminal screen right as the opening bell rang, and I actually felt my stomach drop. Not because the market was crashing, but because the algorithm finally broke. The old rules of financial physics just snapped in half right in front of us. It is Friday, February 27th, 2026. We are deep into the midday U.S. trading session, and Wall Street is currently panicking to cover their tracks before you realize what they've done. At 8:30 a.m. Eastern, the January core PPI, the producer price index, printed at a staggering red-hot 0.8%, more than double the 0.3% forecast. Under the old regime, under the textbook rules you and I were taught, a massive inflation spike like that means the Fed has to tighten, the dollar index rockets, and precious metals get absolutely slaughtered by algorithmic short selling. But that didn't happen today. Instead, silver violently spiked, tearing through resistance to hit an intraday peak of $93.29 an ounce, before settling in this midday session at an explosive $92.02. Gold absolutely obliterated the ceiling, smashing into $5,146.70. Why? Because the smart money knows the truth the financial media is desperately trying to hide. We have officially entered stagflationary panic. Capital is violently rotating out of the bloated AI-heavy equities that have dominated the last 3 years, and it is scrambling for the only exits left: long-duration treasuries and physical, hard assets. The 10-year yield just collapsed below 4% for the first time in months, even with inflation roaring back. The system is choking. Welcome to the Income Decode. If you want to survive the greatest wealth transfer of our lifetime, you need to hit that subscribe button right now. The mainstream media is giving you yesterday's narrative, trying to convince you to hold the bag on overvalued tech stocks while institutions quietly drain the vaults of the only assets that actually matter. We are tracking the money in real time, pulling the raw data Wall Street hopes you never see, and giving you the exact blueprint to protect your family and your future. Subscribe, because by the time this hits the evening news, the window will be closed. Let's reconstruct exactly how this Friday trap was set, because you need to understand the sequence of events to see the sheer scale of the manipulation. All week, there were whispers. The mainstream financial networks were casually dismissing the fragility of the AI equity bubble, telling retail investors to buy the dip. But behind closed doors, institutional desks were quietly dumping paper and looking for liquidity. Then came Thursday night. Geopolitical backchannels started lighting up. The U.S.-Iran nuclear talks, which had been the singular fragile thread holding Middle Eastern energy stability together, abruptly and permanently stalled. The geopolitical risk premium skyrocketed overnight, but Wall Street algorithms were still trying to price in a soft landing. Then Friday morning arrived. The 0.8% PPI number hits the tape. Inflation isn't just sticky, it's accelerating. It's a stagflationary nightmare. But the absolute final nail in the coffin dropped just hours ago, during this very midday session. The U.S. administration officially invoked Section 122, implementing a sweeping 10% global tariff with explicit back-channel signals of a 15% hike coming next following a recent Supreme Court ruling. This is a massive protectionist pivot. It is the ultimate inflationary catalyst. Wall Street immediately realized they were caught offsides. They had spent the last 2 years betting on a deflationary tech utopia. Suddenly, they are staring down the barrel of a global trade war, structurally entrenched inflation, and a geopolitical powder keg. And what did the institutional money do? They panicked. They bought the 10-year treasury, driving yields below 4%, because they are betting the economy is going to hit a brick wall so hard that the government will have to print trillions just to keep the lights on. And they bought gold, they bought silver, they bought everything they could physically get their hands on, pushing gold to $5,246.70 and silver to $92.02 in a matter of hours. But here is where the story gets terrifying. Here is the anomaly the mainstream media is absolutely refusing to talk about today. You see the ticker on CNBC, you see silver up, but what you don't see is the structural terror unfolding in the physical vaults. Let's do a deep zoom into the belly of the beast. Let's look at the COMEX. When you buy paper silver and ETF, a futures contract, a derivative, you are buying a promise. You are buying a piece of paper that says someone, somewhere, owes you an ounce of silver. Wall Street loves paper. They can print paper, they can naked short paper, they can dump billions of dollars of paper silver onto the market at 3 a.m. to trigger stop losses, shake out retail investors, and artificially suppress the price. But paper only works if the people holding it don't ask for the actual, physical metal. I pulled the raw COMEX vault data just before hitting record today, and I had to rub my eyes. I checked the spreadsheets 3 times because the math simply does not work. Registered deliverable silver, the physical metal sitting in the COMEX vaults that is actually available to be delivered to contract holders, has plummeted by 31% since October. 31% real gone. Multiples of demand are chasing a vanishing supply. The inventory has officially dropped below the critical psychological and mathematical threshold of 90 million ounces. As I speak to you right now, there are approximately 88 million ounces of registered silver left in the COMEX. 88 million ounces. Remember that number. I want that number burned into your brain. 88 million. Now look at the other side of the ledger. Look at the paper illusion. The paper open interest on the COMEX, the amount of silver that Wall Street has promised to deliver if called upon, sits at roughly 230 million ounces. Do the math. There is a staggering 400% plus paper to physical supply gap. There are over 4 claims for every single ounce of physical silver actually sitting in the vault. Wall Street is playing a game of musical chairs on the deck of the Titanic, and the music just stopped. If even a fraction of those paper contract holders wake up to the stagflationary reality of a 0.8% PPI print and a 10% global tariff, and decide they don't want a piece of paper anymore, if they decide they want the physical metal, the system breaks. It defaults. The COMEX cannot physically settle those contracts, and Wall Street knows this. That is why today's price action is so critical. The spike to 93.29 wasn't just a rally. It was a structural glitch. It was the physical market bleeding through the paper suppression. The institutions are desperate. They are terrified of a $95 breakout. Why 95? Because 95 isn't just a number on a chart. It is the existential threat level. If silver holds above $95, it triggers a cascade of algorithmic buying and forces massive short covering. The banks that have suppressed this price for decades will be forced to buy back their short positions at a devastating loss, exactly at a time when the physical inventory is sitting at a pathetic 88 million ounces. They need your silver. They need retail investors to look at this $92.02 price today, think, oh, that's a nice little profit, and sell. They are setting a Friday trap. They want to shake you out of your physical position so they can cover their own catastrophic paper liabilities before the entire global supply chain realizes there is a massive deficit. But it's not just retail waking up. The sovereign powers know exactly what is happening. While Western media distracts you with political theater and AI stock earnings, central banks are executing the largest wealth accumulation strategy in modern history. The central bank gold floor is rock solid. Sovereign accumulation is historically aggressive. Based on today's intelligence, central banks are actively buying and are on pace to remove another 850 tons of gold from the market in 2026. 850 tons. They are converting their fiat currency, their unbacked paper, into Tier 1, zero counterparty risk assets. They are draining the physical supply. They see the 10-year yield collapsing. They see the Section 122 tariffs. They know the dollar's purchasing power is about to be systematically devalued to inflate away the staggering global debt burden. So they are buying gold at $5,246.70. And if the central banks of the world are perfectly comfortable accumulating physical gold at $5,200 an ounce, why would you ever let Wall Street convince you to sell your silver at $92? The disconnect between the paper illusion and the physical reality has never been wider. We are watching a tectonic shift in global capital. The rotation out of tech and into hard assets isn't a one-day trade based on a hot PPI report. It is a structural repricing of reality. Wall Street has relied on the paper market to keep the masses pacified. As long as the paper price of silver looked boring, nobody asked questions. Nobody demanded delivery. But the illusion is shattering. 88 million ounces, 230 million ounces of open interest, a 400% gap. They are trapped. And today, on this Friday, February 27th, they are desperately trying to engineer one last shakeout. So, what is the endgame here? Here's my thesis for exactly how this plays out, and why Wall Street is setting the ultimate Friday trap right now at $92.02. The institutions know that a structural deficit cannot be papered over forever. You can print futures contracts until the ink runs dry, but you cannot print a physical silver bar. The 10% global tariff under Section 122 guarantees that the cost of mining, refining, and transporting industrial metals is about to skyrocket. The 0.8% core PPI print guarantees that stagflation is no longer a fringe theory. It is the mathematical reality of the U.S. economy. They know that when the 230 million ounces of paper open interest figures out there are only 88 million ounces of physical metal left in the COMEX, a 400% supply gap, the price won't just rise. It will gap up violently. So, their only survival strategy is to engineer volatility. They want to whip the price around. They want to flash smash it. They want you to look at that $93.29 intraday peak, watch it slide back to $92.02, and panic sell to lock in your meager fiat profits. They are hunting for liquidity. They need your physical silver to cover their catastrophic paper shorts before the $95 breakout makes them mathematically insolvent. Now listen to me closely. This is my opinion. It's not financial advice. Do your own research. You have to understand your own risk tolerance because the volatility we are about to see will break weak hands. Could my thesis be wrong? What are the downside risks? The primary risk is a global deflationary credit event. If the US-Iran nuclear talks miraculously resume and a historic peace deal is signed over the weekend, energy prices could temporarily collapse, dragging the inflation narrative down with them. Or if the broader equity markets finally implode under the weight of this AI bubble rotation, we could see a severe liquidity crisis. In a true liquidity crisis, hedge funds have to sell their winners to cover their losers. Everything sells off. Gold sells off. Silver sells off. But you have to understand the psychology of these drops. If silver gets slammed down $10 on a broad market liquidation, that is not a permanent destruction of value. It is an institutional shakeout. It is a wealth transfer from the impatient to the convicted, because the second the dust settles, the structural reality remains. 88 million ounces in the vault, 400% paper claims. The math always wins. Let's zoom out. You need to look past today's midday session. We are not just trading a hot inflation report. We are witnessing the unwinding of a 50-year global debt supercycle. Since 1971, the entire global economy has been built on the illusion of infinite cheap fiat currency. But the bill has finally come due. The 10-year Treasury yield collapsing below 4% while inflation rips at 0.8% tells you everything you need to know. The bond market is screaming that the real economy is dying, and the only way out for the Treasury is to inflate the debt away. The US dollar is being structurally repriced on the global stage. Look at what the central banks are doing. They aren't day trading ETFs. They are quietly, relentlessly removing 850 tons of gold from the system this year alone, 850 tons. They are hoarding physical gold at an astonishing $5,246.70 an ounce. They are building the financial lifeboats for the new monetary system, and they are using the paper market to keep the masses distracted on the sinking ship. This is a geopolitical power shift disguised as a market rotation. The East is buying physical. The West is trading paper. You are standing at the edge of the greatest asymmetric opportunity in modern history. By understanding the data the media hides by seeing the 31% drain in registered silver, you are front-running the smartest, most ruthless money on the planet. You are early, you are awake. Most people will only realize what happened when silver breaks $95, triggering the short squeeze that tears the COMEX apart. By then, the premiums on physical metal will be untouchable. The wealth transfer will be over. The trap is set. Wall Street is begging you to sell. Are you going to hand over your hard, real wealth to bail out a billionaire's trading desk? Or are you going to hold the line and force them to face the mathematical reality they created? Let me know in the comments. Do you think the COMEX will survive the year, or are we looking at an imminent physical default? This is the Income Decode. Stay sharp, stay stacking.